So today I'm going to talk about investment banking. Who's interested in a career in investment banking potentially? Put your hand up. Right, cool, we're in the right place. So you've seen this slide before if you've come to any of my Investing 101 sessions. Vice President this year, Vice President last year, writer for the Student Investor blog. I do maths with you in computer science, and I actually had a week work experience in UBS Investment Bank. So that kind of gives me some credentials to give the talk I'm doing today. Okay, so I'm going to give you a holistic overview of what an investment bank actually is. So when you apply for a role, you're going to know what role you're applying for, what you are going to do in that role, and if you're actually suited to be in that role. Okay, so it's actually really important that you pay attention because it can be really important for your career. So I'm going to start by just talking about why do investment banks exist. And to do that, there's two separate sides of the story. There's the buy side and the sell side. So before I launch into that, you've all heard of the Goldman Sachs, the JP Morgans, the Lazard, Evercore, Glencore, and then Citigroup. There is a difference between what bank you get into. Tier 1, Goldman Sachs, JP Morgan, that's the elite. Then you've got the Lazards, then you've got the UBS, Credit Suisse. If you get into any of them, you're doing unbelievably. But the end goal of a investment banker sitting in the M&A and advisory side is to move to private equity, venture capital. That's your exit plan after 2 or 3 years. And the way you do that is by going to a tier 1 bank, because your competition is everyone at all these investment banks. So if you start in tier 1, 1A, you've got the best chance of getting the best paid private equity venture capital firm once you've finished after 2 or 3 years. And the pay grades are like starting at 300K, 400K at private equity venture capital firms. And they only hire from these investment banks, essentially, any of those 3 tiers. Okay, so if you went to the Amplify trading event yesterday, put your hand up if you went to an Amplify trading event yesterday. All right, fantastic. That's all about trading. Now, traders sit on the sell side. In an investment bank, over here, you will have a big trading floor. Everyone in that floor will have like 6 screens in front of them, and they'll be shouting across the room, buying and selling different financial securities. It's a bit of a crazy place, a trading floor. There's unlimited free coffee at most of them, because you'll be there for a long, long time. There's also the buy side. The buy side has got hedge funds, asset managers, pension funds. The point of the buy side is to buy financial securities for their clients. Say you're a pension fund, and you have $1 trillion worth of assets because you're BlackRock, for example. BlackRock's the world's biggest asset management company. How do you put in an order of £100 billion into any stock? Can you go on your Trading 212 app and put an order of 100 billion worth of Apple? The answer is no. If you do that, you'll lose a lot of money due to various reasons, such as slippage and liquidity problems. What you do, you go to an investment bank. You approach Goldman Sachs, you approach UBS, and you say, look, I really want to buy 10 billion worth of whatever, and they'll say, okay, we can do that over a 3-month period without moving the market too much. An investment bank is a service. Okay, they don't sell a product, they sell a service. So it's a service-led industry. Okay, if you heard of the acronym FAS, finance as a service. Okay, that's really, really important. Investment banks sell themselves, they sell their people, they sell their experience. The stuff that happens in an investment bank, you can only get the product at the investment bank. And you learn those skills in investment banking, which is why it's so important. Okay, this is just covering again what I said, so you can take some notes if you want. Again, I said before, the buy side, their whole objective is to buy stuff, right? You're an asset management company, you want to buy assets, you go to an investment bank and you buy those assets. And the sell side provide those assets. So you've got the buy side and sell side. Okay, and I'll be talking about each subsection of the buy side and the sell side throughout today's session. So you get a good understanding of both sides and where your career is going to fit in if you decide to go into that career. Personally, I applied for asset management and sales and trading. So I applied for this role here and this role here for internships last summer. And I got through to quite a few assessment centers. Okay, so the buy side, they're the people that have the most money. They want to buy assets, as I said. What type of job are you going to be doing in a hedge fund, an asset management company, or you manage money? And for that reason, your hours aren't going to be as crazy as an investment banker per se. But sometimes if you work for a hedge fund, you're going to have a much higher salary. So everything that I say, take it with a pinch of salt in terms of salaries and working hours. There's obviously exceptions to every single thing that I say, so be aware. But what I'm saying is, usually this is the case. Okay, then you've got venture capital, private equity. Does anyone actually know what it means to be a venture capitalist or to be in private equity? If you just give me an answer, get a free water bottle.
Venture capitalists look for potentially more risky investments. They put money down, let's say in early startups and things like that, and they look for large returns but potentially high risks as well.
Good. If you're in private equity, your whole business proposition will be looking for unicorns, looking for the next Facebook, the next Google, the next Instagram, and if you can value the company, so you use the skills that you've gained in the investment banking side, you're amazing at valuations, fundamentals, then obviously they're going to want to hire you because you can identify an amazing company. Congratulations. Okay. So yeah, the buy side slightly less intense than the sell side because you're managing money instead of trying to make money, if that makes sense. And what are some asset managers? BlackRock, the world's largest, like ridiculously huge. Charles Schwab, they've been around for ages. A lot of investment banks have an asset management arm. So you have Goldman Sachs Asset Management, you have Morgan Stanley Asset Management within the investment bank. So it's quite important that you can have these things within a big investment bank. Some investment banks only do investment banking, like Glencore, Evercore, Lazard. But also you've got hedge funds, and the most famous one is probably Ray Dalio's one, Bridgewater Associates. Read his books, absolutely incredible. His most recent one is The World's Changing Order. It comes out on November 30th. I'm very excited for it. He's a very smart guy. Okay, so yeah, let's go through a little example of how much money the buy side is dealing with so you get to grasp it. Every single big company, every single company must provide a pension scheme. Anyone who wants to be an actuary will learn something about pensions within their journey. You've got defined contributions and defined benefit pensions. I did some work experience in the field of actuaries, and so that's how I know this. So a pension, when you go through life, your company probably automatically puts a part of your salary into a pot. That pot is the company's pot. What are they going to do with it? Are they going to let inflation destroy it over 40 years? No, they're going to give it to Aviva investors. They're going to give it to any asset management firm, which is credible, and say, look, I want 8% interest over the next 45 years, please. And to do that, they need products to buy, and the products which they buy are on the sell side. So let's talk a bit about the sell side. So the sell side is all about investment banking, more so than buying the assets. So the buyers go to the investment banks to buy the products with all this money they have in their respective pots. So yeah, you've got something called advisory mergers and acquisitions. If a big company wants to take over a smaller company, they can acquire it. If two companies want to combine together to be bigger, that's called a merger. If you want to get into mergers and acquisitions, that's probably the longest hours. Be working anywhere between 18 and 22-hour days. My best mate's sister works in Deutsche Bank as an investment banker, and she works literally 120-hour weeks. But next year, she's moving to a private equity firm, and starting salary is like 200, 300K, which is amazing. If you want to put 3 years of your life into something a bit dull, in my opinion, then the exit opportunities are amazing, and the pay that you get at these venture capital private equity firms, they'll give you the best life you can have, essentially. And then, of course, large bonuses contribute to the big pay. Okay, so my experience is more towards sales and trading. I sat with my uncle on the trading floor at UBS. He is the head of technical analysis. So I was sitting at the back with the research team, but I got to rotate through all the desks and speak to all the different departments. They don't call them departments, they call them desks. My favorite desk was the equity derivatives desk. They were all from Cambridge, they all did economics, but for some reason they could all code. And they spent their time, the supervisor, there was 11 guys and 1 girl, the supervisor walked up and down this like array of computers, sort of how it is now, it's a bit wider apart, and they were trading and equity derivatives. Who knows what derivative is? Put your hand up. Yeah.
So basically, you have stock, shares, and you have derivative like options, futures.
Yeah. Can you give me what is a option?
Basically, an option is like in the future, they give you the option to buy a stock.
Yes. It's an option to buy something. It's not, instead of buying the underlying asset, for example, instead of buying a share of Apple, instead you can buy the option to buy a share of Apple at a specific time in the future. And obviously you've got to pay for that. You've got to pay for that convenience. The bank's taking the risk. The holder of that contract taking a risk, as opposed from you. So that's my favorite desk, and they're all very, very smart people. In the morning, I used to get in the office at, well, I left my house, I live in London, I left at 4:30 a.m. I got into the office in central London at 5:30 a.m. They eat breakfast they eat breakfast at their desk. You read through your emails in the morning. You attend your morning briefings before the markets open. The markets open at 8 a.m. in London, so the morning briefings will be about 6:30 a.m. Everyone sits in a room. The expert on whatever thing they're talking about will lead it, and everyone else will sit around. Basically, it's a hot seat, and they fire questions at them, and they're just giving their opinion about, if they're an expert in the telecommunications sector and something's happened, they'll talk about it, and everyone else, the traders, will say, yeah, what's happened? You're the expert. You're smarter than me. Tell me what's happening. You do a bunch of stuff on the desk. You check. One thing is compliance. Everyone there is always talking about, being careful, not getting caught by it, so obeying the laws of the FCA. You network with people. You have lunches. You get your name out. Okay, so just to highlight the separation between an investment bank. So we're in the sell side, we're in the investment bank, But within this investment bank, there's loads and loads of different things inside the bank. So as I said, I was in the global markets division. Now, global markets is different to investment banking. This shouldn't even be called investment banking, because in the actual bank, they call it like I forgot what the actual word was, but they call it a wall. And this wall they have in the bank, your key card doesn't physically let you into the different part of the bank. Why do you think the bank is so careful of physically splitting up these two areas that you actually can't get into the other area of the bank? Why? Anyone put their hand up and get a free water bottle if you answer. Why do they separate these two things? Yeah.
I'm not sure, but prevent inside trading.
Yes, prevent insider trading. Sorry, pass it backwards. They prevent insider trading. How does insider trading take place? Well, if you know that two companies are merging, or you know that one company is taking over another company, and you know about it before it happens, usually the price of the stock will change when it becomes public information. So I believe you've got the people taking over this company. If they're both publicly traded companies, the smaller company, their asset price will go up, or the stock price will go up, and the bigger company, the stock price will go down. But generally that's what happens. Why does that happen? The stock price goes down for the bigger company because they're paying billions and billions of dollars, probably a bit over what the actual smaller company's worth. So when Apple bought Beats, that's just an example, Apple can buy Beats, Facebook bought Instagram and WhatsApp, the stock price will change. If you know it's happening and you're sitting as a trader thinking, how can I make a lot of money today? And you just walk over to the side of the bank, like stick your ear in, say, what's happening? And you hear a wind of whatever's going on, and you make a trade, and you're guaranteed to make money because it's the guaranteed it will move in that particular way by economics. You'll be done for insider trading and be thrown in jail for like 10 years. So that's why there's a physical wall between the two sides of the investment bank. They do not talk to each other. Even on suspicion of insider trading, you do not want to be investigated by the FCA for anything. They will throw you in jail. They will do horrible things. Cool. So you've got to think to yourself, on the investment banking side, do you want to be the people working on deals, or do you want to be sitting and making trades? That's a massive decision that you need to make. I would say you need to do a year's preparation if you want to go into M&A. It's basically doing a mini degree on the side, because when you go into the interview, they'll ask, what's leverage finance all about? What's equity capital markets all about? What's debt capital markets? And they'll ask you some weird scenario, very technical, and you've got to have a plethora of information to answer their questions. On the other hand, if you work in sales and trading, it's less technical. The interviews are more competency-based questions. In my experience, obviously they'll ask you, what the hell is this? What are you going to do in your job as a sales trader? What are you going to do in your job as a trader? And they want solid answers. So I'm going to go into each thing now and talk about it. And we're going to start off with the investment banking division, so the deals part of the bank. Okay, so I've kind of talked about all this already, just going to go into a bit more detail now. So you've got your mergers, that's when two or more companies are combining. It can happen for multiple reasons, and the main reason is profit driven, cash is king, you do it to make money. But also Facebook probably bought Instagram, not because they thought they were going to make loads of money out of it, but because it fits into their ecosystem, it fits into their vision. Other companies might acquire a smaller company just to remove them from the market. If you don't want competition, you can simply buy them out and crush them. The amount of oil and gas companies that have bought out sustainable companies and just killed them is quite disturbing if you research it. And who are they going to go to? They're going to go to your favorite Goldman Sachs, JP Morgan, UBS. And the main difference between Goldman Sachs and UBS, they'll go to Goldman Sachs. Goldman Sachs won't have to bid for the business. UBS will have to bid for the business just because of their reputation. So the business comes to Goldman Sachs, UBS gets the business, if that makes sense. So there's more work to do, bigger deals, more deals at tier 1 investment banks. Okay, debt capital markets. Who knows what debt capital markets, apart from this, is really all about? Who's brave enough? Anyone? All right. Debt capital markets is all about bonds. Now, does that sound fun? Your whole job is just looking at bonds? Maybe, if you're into bonds. Can anyone tell me what a bond is? On the other hand, that's a lot easier. What is a bond? Yeah.
Bond is lending money or capital and expecting money to be given at some time with interest.
Yeah, fantastic. Well done. A bond is simply an IOU. For example, if I say I'm Apple, I decide I want £100 million to do some research and development. How am I going to get £100 million? Well, I'm going to go to the bond market and see who's nice enough to give me a bond or many bonds that can accumulate to 100 million. And in return of that money, there's no free lunch in finance. In return for that money, they're going to expect regular payments. So maybe 2% a month, maybe 5% a month, maybe 10% a month. And if you're one of these companies who are literally, you have a negative cash flow, so that means you're spending more money than you are making money per day, eventually your business is going to run out of money. Who's going to save you? You call up your investment bank, you call up Evercore, Glencore, Lazard, and you say, shit, I'm about to go bankrupt in 31 days, help me. That's what you would do on the M&A advisory side of an investment bank. You are literally sitting there with a phone in hand, trying to make this business not die. That's quite exciting. But whether you want to do that 22 hours a day, it's up to you. Back to debt capital markets. Essentially, they're buying and selling bonds on the secondary market. And they're not traded like stocks and shares. They're through an investment bank. They could be 5-year, 10-year, 30-year bond. There's something called the LIBOR. It used to be a LIBOR. The Bank of England can set the interest rate every single day. That was the case previously. Someone found a loophole. Now it's not the case anymore. And another thing called leverage finance. And that's where you'd focus on getting more risky debt. So something which is more risky debt, say the customer has 31 days to survive, why would you give them £100 million if they've got 31 days to survive? Or someone would, if you can give them back 30% interest a day. That would be quite, that would be better, but they might not last 31 days, they could go bankrupt the next day. So it's all about risk and reward. And then you've got on the other side of things, you've got equity capital markets. So equity capital markets is all about the stock market. When a company wants to go public, so what is an example of a company wanting to go public? Well, does anyone know the car company that just went public 2 days ago?
Rivian.
Well done. Do you know what Rivian is? Do you want to give an explanation to everyone?
It's an electric company, but I'm pretty sure they have no revenue, right?
Yeah.
They're doing like this truck, sort of for the American market.
Yeah.
They have an IPO and it's, I could say it's 150 billion value, right?
Yep, over like 2 days. But who's behind the car company?
Who's behind?
Yeah. Amazon.
Yes.
Yeah. It makes sense. Amazon and Google team up, make a car. It's worth 158 billion before they even start. Which is fair enough. Amazon and Google together, they can, maybe make a car better than Elon Musk. Who knows? One of the main things that you do in an equity capital market is make a company public. So when Rivian went public, it wasn't just one day they woke up and thought, I want to be on the stock market. Let's do it. No, they probably called up about 100 different investment banks worldwide. Maybe 40 investment banks said yes, and they agreed a price. And they're called book runners. All these investment banks work together on the same deal. So I know if you want to look it up, who worked on the deal with Rivian, I'm not sure. That I guarantee you there'll be at least 15 different investment banks working on that deal. Why do you need so many? Well, why do you think the stock just shot up by 158 billion? The investment banks are behind it, right? In preparation for the IPO, there was a lot of pre-selling. The investment banks, well, it used to be the case, all the big senior managers, they fly around the world schmoozing the buy side, and they're basically, it's called a roadshow. They went through a roadshow. They really sell and schmooze people. It's called a beauty show, actually. Another jargon word. They go around the world pitching it to the buy side and saying, look, buy this, buy this, buy this. They'll wine and dine the buying side. They'll take them out for golf events. They'll literally, if someone's putting an order of $1 billion, whatever, so you get treated very nicely. But actually, I spoke to the head of equity capital markets at Royal Bank Canada last year. I said to him, how do you do roadshows over COVID? How can you possibly meet people and take people out for whatever? There's no flying. And so they said, well, actually, they've been doing it all virtually, and it's been just as successful virtual as it was in person. But obviously, if you're signing multi-million-pound deals, you want to shake someone's hand and be taken out for dinner beforehand. So a lot of the meetings can be done virtually, and they see it being done virtually in the future, and it's going to be this kind of hybrid. So they'll have meetings virtually, but the actual wine and dining, schmoozing aspect, that's going to come back. That's what you told me. That's what you can use if you go for an equity capital market role. Knowing these terms, roadshows, IPOs, book runners, all these key terms, you'll impress people. Okay, equity research is actually on both sides of investment banking. Equity research is essentially fundamental and technical analysis. All the investing one-on-one sessions that we've been to on Monday nights. That's essentially the very basics of equity research. You find a company. So, for example, when I was shadowing the team at UBS, they had a book this thick of potential companies to pitch to a client. They were filled with data. They were filled with the financial reports, and they were filled with their opinions, what they thought the key drivers were for these particular companies. And a few of them, I'll tell you now because it's old news. In 2016, they predicted NetEase, a Chinese gaming company. They predicted Disney to their clients in 2016. Don't know if you know about those two companies, but they've gone like this in the past 5 years. And many others who I should have taken a note of at the time, but I was only 16. And if I knew, I would put all my money in those companies, because the team at UBS, they're extremely smart, and they definitely knew what they were doing. And my uncle did a technical analysis, the other two guys were doing fundamental analysis, and the other people in the team were facilitating their work. As a junior equity researcher, you'll do what your head of department tells you to do. Okay, any questions about the investment banking division of an investment bank? Anything which you want to ask me now before we head into the fun side? No? Cool. All right, so global markets. This, I wouldn't even say this is like proper investment banking. All right, this is global markets. This is stock markets. This is trading. This is Wolf of Wall Street style, right? This is the fun part of trading. You can imagine this kind of things that would keep people going on the trading floor, which I probably can't say in a recording. But those sorts of things, potentially at UBS, my uncle was telling me about a team of 6 derivatives traders that trade throughout the day from 8 to 4:30 p.m. They'll have drinks and stay out until 1 a.m. They'll get smashed and they'll come in the office and repeat at 4:30, 5:30 a.m. and just repeat. My uncle said he had no idea how they survived. Maybe you have a few opinions how they survived their time at UBS. They were really successful traders and they made a lot of money. The bank doesn't care what you do in your spare time unless you're making money. You're making commission. Cool. So global markets is stock market. So it's this kind of thing. Okay. Inside the investment banking global markets division, it's not just trading. There's a bunch of other stuff that which they do. One of those things is called restructuring. So a company might go to investment bank and say, look, my company's not doing as well as I think it should do. If you jiggle some things around, fire some people, reshuffle the objectives of our company, hopefully that can make it better. That's one of the main arms of an investment bank. They have a restructuring department. You've also got sales, and after sales, we've got trading. So what's different between sales and trading? Is there a fundamental difference between the type of person who's going to be a salesperson and a trader? Put your hand up if there is a fundamental difference between the type of person who would be a sales or a trader. No one? You don't think there's a difference? Well, at UBS, the salespeople are the most extroverted, friendly. If you start chatting to them, they'll hold you in a conversation without you even realizing you're in a conversation. Right? They're born salesmen. The traders are a bit quieter, sitting at their desk, not necessarily screaming down the phone and trying to sell stuff. They're executing trades, thinking of new ideas. Salespeople are very much on the phone to clients, they're schmoozing them. They still need to know what's happening in the markets because the clients will ask them, oh, what do you think about this event? And they'll give a good answer. But really, their answers are going to come from the traders. And they've got a great relationship with the traders. It's a two-way relationship which they have. The traders might be proprietary trading, so they might be trading with the bank's money, and the bank might decide, if you've ever seen the movie Margin Call, which is, anyone seen the movie Margin Call? Okay, a few of you have, so I'll use an example. Watch it, okay? It's an amazing movie. And then what happens in Margin Call, the bank realizes they're holding really, really crap assets, really, really bad stocks. And the head of the bank basically says, I don't care how you do it, I want them gone. So the traders go to the salespeople and say, look, the bank's told us to get rid of this thing, find clients, and sell it to your clients. Now, obviously, if you fuck over your client and give them a bad stock, they're not going to come back. They're going to hate you forever. And the salespeople in that movie were like, there's no way we're doing it, fire us. I will not ruin my relationship with my client just because just because the bank made a bad decision. So what did the bank do? They were like, we'll pay you so much money to do this, and then you'll never have to work it in your life. So they did it. They stabbed their most trusted client in the back, gave them this absolute rubbish stock, and made so much money they had no idea what to do with it. Is that ethical? Yeah, why not? You're not breaking your rules. There is no rule to say you can't do it. The FCA have not said you cannot sell a stock which is going to go down. Stocks go up and down. It's not financial advice. Or maybe they thought they were doing it in their best interest. We'll never know. Yeah, so that's what sales. Yeah.
If you work in sales and establish a good relationship with clients,
Yeah.
you just something really the bank and work in since you have relationships.
I think it definitely depends, but I wouldn't be surprised if your client follows you. If you moved laterally from Goldman Sachs, JP Morgan, I would if you know the client, they'll move with you. Okay, you've all got your favorite hairdresser, you'll move with them if you like. Unless there's a predetermined rule in that particular bank which you can't exchange personal emails, personal email addresses rather than work emails. Because if you get fired or whatever, they'll literally take your phone away and that's it, you've lost all your clients. Obviously, when you wine and dine them, you get to know them, you'll know where they go on Sunday golf or whatever. You can do your own thing, right? There's not really a law. There might be a law, but I'm not completely sure. Okay. And obviously, at UBS, there's actually a rule that you can't spend more than, I think, £300 to £400 on a gift for a client. Because previously, you could buy them Rolexes. Yeah. If they're a client, doing £10 billion worth of business, you'll take them out for food, wine and dine them, right? But there are limits now on how much you can do that. It has changed a little bit since 2008. Okay, so trading. I'm not going to read off the slide here. One of the main points about trading, which I think everyone needs to understand, London is situated in the most optimal time zone for trading. The American markets open at about 1 or 2 p.m. UK time, and the Asian markets close just as the UK markets open. That's why, and everyone's like, oh, Brexit, what's going to happen to London? Nothing's going to happen because you can't magically get London and put it somewhere else. We're in a perfect position, time related. So that's why London's so powerful. That's why London's done so well in terms of trading, and all the investment banks put their banks in London because of the time zones. Yeah, so I already spoke about this. You get in the office early, 5:30, 6:30, morning briefings, and then you start trading. And it's all electronic now rather than phone-based, but sometimes you will hear people shouting across the trading floor saying, I've got 100 worth of, Tesla or whatever. And then someone on the other side will say, yeah, I'll take that. Because obviously, you can maximize your commission by buying and selling a commodity, stock, bond, whatever. If you can do that within your bank, you'll get double commission. So that's why there's lots of shouting. Who's going to buy it? Who's going to sell it? Everyone's got different clients, different needs. And the bank wins twice if you can buy it and sell it within the bank to two different clients. I think that's pretty cool. You can make loads in commission. How much commission does everyone think UBS charges per trade? Put your hand up. Just literally percentage. 3 water bottles on the line, just to give me a random number. Yeah? 8% commission. I'll pass it back, please. A little high, 8%. If they were charging 8% commission, the investment bankers would be way more wealthy than they are. And I guess 1%. 1%? That's still ridiculous. What's 1% of the $10 billion trade? Yeah.
1 over 10,000.
1 over 10,000, that's a bit small. Usually, the guy who I was speaking to, 0.01%. Right? The bank still makes a lot of money, but it's not as much as they used to make back in the 80s and the 90s when they were charging 4 or 5% commission. That's why the investment banking lifestyle, if you did it in the 80s, 90s, and before 2008, it was so lavish that you drove the Rolls Royces, you had the life. It's because the commission was so much higher than it is now. And the reason why the commission is much, much less, and the reason why people say, oh, investment banking is not what it used to be, regulations, increased competition, electronic trading, reduces arbitrage, all these factors reduce commission. Now, do we feel sorry for the investment bankers not making tens of millions and only making millions? No, I don't care. I'm not going to be an investment banker. Okay, and lastly, for trading, there are literal traders who are, their sole role is to be execution traders. So, if you've got £10 million worth of Apple stock to buy, and you put it all on, and you just click buy for £10 million, it's going to go horribly wrong. So people are going to know there's a massive buy order in the market, and the sellers are going to sell you stock at an increased price of what you would have bought originally. Why? Supply and demand. As the demand shoots up and the supply is constant, then the price increases. Yeah, and there's something called front running. A really famous example of front running is the Royal Bank of Canada. There's a book called Fat Boys. Everyone in the Bank of Canada says that is the Bible of RBC, the Royal Bank of Canada. It's all about how they stopped front running with their proprietary software called Thor. Read that book if you want to know more about front running, and really algorithmic trading is the crux of that. Okay. Obviously, the bank makes money through commission. It also makes money through something called the spread. In trading, you've got the bid and the offer, the buy and the sell price. Has anyone, I've talked about the same thing on my technical analysis and in intro to investing session, the same 2 slides. I will briefly talk about it, but not in as much detail as I did. The videos are on YouTube if you want to get a full reason. Essentially, when you buy an asset, you buy a share of Apple, you don't actually buy it at the price at which it says. You're going to buy it for a price slightly different, maybe a 16th of a percentage different. When you would sell the asset, you wouldn't sell it at the exact market price, at the exact price you would sell it at, it would be sold maybe a 16th of a percent different as well. This difference goes to someone, okay? The difference goes to the investment bank. So if you were to simultaneously buy and sell an Apple share, you'd lose money. It wouldn't be an aggregate sales and buy of 0. You would lose money. You could try it now. Download Trading 212, buy Apple and sell it, and you would have lost the money. And that's because of the spread. And this is just an example. I'm not going to go into it. Okay. There's a few more things I want to talk about. Something called structuring. So inside the investment bank, if a client calls up and they say, I don't want to buy a share of Apple, I want to buy an instrument that tracks Apple, but also incorporates, for example, the S&P, CPI index, the consumer price index, the PMI, all the different economic indicators. If they want to get a really tailored product, which doesn't exist, but they want it, investment bank can make it for them. They'll call up the structuring team, and the structuring team will make it for them. Now, you might have heard the word derivative. I'll talk about it earlier on in this session. So they're not going to buy a share of Apple. They'll buy something which derives its value, or gets its value from the underlying share Apple. So, for example, that could be a contract giving you the right to buy Apple at any point in the future, the next year or so. Now, how much do you pay for that premium? How much do you pay for the option to do these crazy things? It's not going to be free. And so who prices these things? The quants. If you're a quantitative finance, part of their job is to price the products which the structurers make. So they will be mathematicians and they will be programmers. Anyone know what this equation is called?
The Black-Scholes?
Yeah, Black-Scholes equation. Fantastic. You just won yourself a water bottle. This is the Black-Scholes equation. I'm 30 year maths. I do module maths and finance. This is a Nobel Prize winning equation. I can derive that equation. That will be in my example. Who else can derive a Nobel Prize winning equation? The people who do the module as well. So essentially what this does, it tells you how much you should pay for the option. And obviously it depends on a bunch of things. It depends on time, it depends on the underlying share price, it depends on the risk-free interest rate, and it depends on the volatility of the asset. Now, I'm not going to derive it now. It will take like an hour and a half, maybe 2 hours. And the math isn't terribly difficult. Bit of Taylor series, bit of rearranging, bit of algebra, bit of partial derivatives. The hardest thing is probably the hardest thing in there is just a Taylor expansion. That's the hardest thing, and you would learn that in further maths A level. So the actual maths is just A level, but the ideas that are behind it, that's Nobel Prize winning stuff. A quant also spends their time doing high frequency trading, algorithmic trading, but also a big part of the quant's role is to price the products which the structurers have just made for their clients. And to do that, you'll probably need a PhD or a master's at the very, very least. Why do you need a PhD or a master's? Because you're pricing things which have never been priced before. So you're doing research and you're trying to find out what is the fair market value for this particular product. So the skills that you learn doing a master's, doing a thesis, doing a PhD, that's going to really help you in a quant role. And also, you've got to be a fantastic programmer. Okay, asset management. BlackRock, how much they have? So Q3 2021, that just means the third financial quarter of the year 2021. And right now they have just under $10 trillion worth of assets under management. So the reason that they've acquired quite a few firms over the years is because they realized, okay, we're going to charge a 0.1% fee, but if we have the most amount of money in the business, then the fee which we get is going to be absolutely huge. Now, are they too big? Is it dangerous to have one company dealing with $10 trillion worth of assets? Put your hand up if you think it's dangerous. All right, maybe you should go into compliance and bring them down. Yeah, they're absolutely huge. And their main goal is to, if you're a high net worth individual, probably worth over 50 million, you'll go to BlackRock and you'll say, inflation is here, protect my money from inflation and preserve my wealth. That's one thing which they could do. They could deal with pensions. They could deal with insurance companies. Look, these insurance companies have vast amounts of money. The insurance company, when you pay like £1,000 a year for your car insurance or whatever, the insurance company will give it to an asset management firm. They'll make money on the money which you're giving them, but they'll also need their money in cash to pay out as well. So that's asset management. I think it's quite a fun career. There's lots of different roles in asset management. It's very client-facing. You have to. The main part of asset management is to go and get business, go and meet clients, get business. I think that's quite interesting. Right, the last 3 slides is about the front office and the middle office, and then a little summary. So within an investment bank, we talked about the roles, we talked about the different departments and divisions. We haven't talked about where's the money? Who's making the money? So in the front office, those are the money makers. They're the people directly meeting the client and bringing in business. As a result of this, you'll make the most amount of money if you work in the front office. The back office, my dad does HR, human resources. He's not client facing, and as a result, he doesn't earn as much as the sales and traders working in an investment bank. You've got compliance, risk, operations, technology, finance, accounting, that sort of thing. All these investment banks will have their respective divisions, and you don't see as many clients. You don't bring in business. And they're the engine of they just make the bank tick every single day. If someone smacks you on the trading floor because you just lost $100 billion, you could complain to HR, but you wouldn't because you get fired. But yeah, hours are shorter, better work-life balance, and you can still work in the investment bank. All right, further reading. So I really recommend this guy on YouTube called Asal Hussain. He was an ex-Goldman Sachs. He's got loads of YouTube videos on there. If you want to know more about anything on a high level, so I've given you a holistic view, high-level overview of the different parts of the investment bank. He'll do the same thing. If you want to get a bit deeper, get into the nitty-gritties about what actually goes on within each department and the specific details, read a book. That's the best book for it. Or you need to know about City, like Christopher Stokes. Next, if you want to know more about a specific role that you're applying for, get LinkedIn Premium. Reach out to someone who went to the same school as you, who went to the University of Birmingham, did the same course. Reach out to them, ask for a 30-minute chat, and say, please can you talk to me about your role as a equity derivatives trader? Please can you talk to me about being a trader? What's it like to work in risk, to work in compliance? They're more than happy to talk to you, believe me. Their role is interesting, but they like to feel like they're making a difference in the world and getting new people into it. Now, do you need to know everything that I told you and more to get into investment banking? Do you need to know absolutely everything about investment banking to get an offer? No. But the more you know, the better. You're never going to walk into an interview and the interviewer is going to be like, what? You know too much about your role? It's just not going to happen. And lastly, if you want to go into mergers and acquisitions, there's an amazing website called the Merger Site Group, and they produce reports on current mergers and acquisitions. You can see how a report is written. You can apply to write for them. And if you want, and also there's something called Wall Street Oasis, Wall Street Stash, City Investment Training. Like to get into M&A, you've got to do a degree on the side. You've got to know every single aspect of M&A to get into M&A, mergers and acquisitions, advisory. In the interview, it will expect you to know your cash flow, your income statements, your balance sheets. They will expect you to know absolutely everything about the role which you're applying for, and you've got to have insane Excel skills. They spend all their time on Excel, building financial models, doing company comparable analysis, looking at leverage buyouts. I didn't go into any of this stuff because, honestly, I'm not an expert. I don't know about all this because I don't really want to go into this role, so I didn't learn about it. But yeah, M&A is a different beast. And that is, in my opinion, what investment banking is really all about. Mergers, acquisitions, advisory. Longest hours, hardest working, and probably the best exit opportunities. And on that note, at exactly 8 p.m, we're done. Thanks for coming.